Thank you. That was very nice. I don't think anybody has introduced me so eloquently in the past. Very nice intro. Thank you very much, Raleigh. Hey, Gary. Nice to see you. Okay, so we are going to talk today about using the trading zone methodology with a particular focus on market profile. So just briefly, a couple of things. First about me, but you already had that nice intro, so you've already heard what you need to hear, so we won't waste too much time talking about me. Trading since 1992, roughly about 10 years after that, 2003, I started the educational firm, the Trading Zone, and that's where I spend most of my time, working with traders and running the chat room that we run daily since 2003, following different markets. We really cater to active day traders trading the futures markets, the ones you see there, ES, NQ, the Resell, crude oil, gold, etc. All the day trader favorites. And just before I get started, it's important that I just review the disclaimer. I like to do that to make sure that it's always available for the videos. You should carefully consider whether trading is suitable for you in light of your own circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. It's important. Trading is a high-risk endeavor. We use a lot of margin. We use a lot of leverage, so it's important that you understand the risks involved. I'm sure it's not the first time that you've heard this today, nor is it the last time. Al's getting off early with an early question. Is it easier to teach than trade? Well, I was a trader for 11 years prior to becoming a teacher, and I'll say that it actually requires a very different skill set. A lot of people can trade, a lot of people can teach. Some can do both, some can do neither. So I have found myself, I believe, in the unique position to be able to do both. I'd like to talk today, give me 1 second. I forgot to turn something on here. I'm going to talk to you today over the next 45-50 minutes about the trading zone approach. Oops, no, it's not what I wanted to do. Crazy things are happening. Okay, here we go. About the trading zone approach, and I'll get into a little bit of educational stuff. Oh, sorry about that. Over the next, come on, are you done? Okay, I'll get into a little bit of educational stuff in the next 45-50 minutes, and then I'll be able to take some questions as well. So, talk about the mechanics of trading. I'd like to break it down into two broad sectors, or two broad categories. One is the actual mechanics. This is, the physical stuff that we do. Things like technical analysis, chart reading, using indicators, understanding the dome, time and sales, identifying trends, etc. Right? And this is really the pure mechanics of trading. And this is stuff that I equate often to pattern recognition. It's stuff that you can literally teach an 8-year-old. I taught my son how to trade when he was 8 years old, based on the mechanics of trading. So if it were so easy and so simple and every 8-year-old can learn it, then why aren't there millions and zillions of successful traders in the world, right, if it were that easy? And the reality is that when you get into the second big component, the human elements of trading, that's where everything kind of falls apart and you have to rebuild and re-educate and retrain yourself. So although I was able to teach my son that at the age of 8 the mechanics of trading, he was, as I say, unencumbered by the human elements of trading. And of course, when you're not looking at facing a loss, you're going to treat the trade very differently than somebody who has put hard-earned money behind a trade. So, it may sound all great. Wow, taught an 8-year-old how to trade. But the reality is that as he grew to understand the concepts of profits and losses, then we introduced all those human elements. So a lot of what we do as traders, and a lot of the things that I work with, and the traders that I've been working with for over the past decade, is about bridging these two components. And what we've discovered over the years is most traders, as you may have found yourself in this situation, initially approach trading with the belief that if I can master the mechanics, then everything else falls into place. And then they quickly realize that that isn't necessarily so. They master the mechanics, but then things don't seem to go exactly as they had planned. And of course, the reason is the human elements. So a lot of the struggles and the efforts on a day-to-day basis is actually about bridging these two elements. Finding out what type of psychology you have if you are really meant to be a trader. Not everybody is meant to be a trader. Not everybody can trade on a fast or day time frame. Some people prefer a much slower approach. You have to reveal your personal strengths and weaknesses. One of the beauties about being a trader is there's so many different ways to approach it. You can decide to day trade for the first 15, 20 minutes of the day. You can hold a position for the entire day. You can swing trade over a number of days, etc. There's a lot of different ways you can break up different types of trading in order to make it fit your own personality, your strengths and weaknesses, because of course every trader is different. And that all starts with planning your trading business accordingly. We talk about planning a business, a trading business. We start with an exercise that reveals some elements about your psychology. And what I mean by that is we take you through an exercise that has you determining how much is the most amount of money I'm prepared to lose. And I know it sounds a little bit weird. Most people say, well, if I want to be a trader, I don't want to lose money. Why would you ask me that question? And the answer is that you can't really address the profits until you've taken full responsibility of the potential losses. So going through this prior stage of building a proper trading business plan says, this is what I'm prepared to invest in my business. This is how much I'm prepared to lose if things go terribly wrong. You take full ownership of that number, right? Gee, if things really don't go well, how bad is it going to look? And then once you take ownership of it, once you take full accountability of the downside, then you've taken the first step in identifying the personality traits that will allow you to develop a business plan suited for you. And maybe it is rapid fire scalping, or maybe it's swing trading, etc. So a lot of what goes on beyond the mechanics of trading is bridging this human element with the actual techniques. Now, that's general information, right? I haven't taught you anything new or revealed anything mysterious. It's just how I like to approach trading from the broad to the narrow. When we get into the actual trading zone system, I talk about 4 cores, or actually I call them 3+1, as you can see here from these pillars. And this now we'll discuss the actual trading zone approach to how we do what we just discussed in terms of developing the best trader you can be. So these 3 cores are the following. Market profile, which is a tool and a technique that we use to determine and assess the broad market. It's kind of like a roadmap. You want to drive from New York to Chicago, you want to be heading west. You get out your roadmap and you plan your trip. Market profile provides that type of information. Where does the market want to go? Which direction does it want to go in? Is it looking to be traded to the long side or the short side? It's what we call market structure. So first determine what market structure is, as revealed to us through the indicators of market profile. The second pillar is patterns and inflection points, which basically means there's going to be some places on the chart that are just better opportunities than others. Something has happened in the recent past, and that's a better place to take a trade, or maybe something has happened in the recent past, could be 5 minutes, could be 5 days, where it's a less advantageous spot to take a trade. Now, some people may call those support and resistance areas. It's a couple of terms that I don't like to use because it mistakenly tells people that every level below you is something you want to buy and every level above you is something you want to sell, and markets don't trade like that. Sometimes we want to sell into a level below us because the market wants to take it out. So I try to avoid the terminology of support and resistance, supply demand, just because visually it sometimes gives an inaccurate vision of what I'm talking about. So the second core is, all right, once we've decided market profile-wise which direction we want to go in, then we're going to go find the best spot on the chart in order to provide that trade. And once both of those things combined have told us, great, we're looking to trade long because the structure of the market is long, and we have found the right inflection point or pattern for our entry, those are execution tools, we then want to do one last thing, which is evaluate the energy of the market as determined by price action or order flow. And that's the third pillar, which is something that we've borrowed from floor traders over the years, which basically means the following. Once you've determined cores 1 and 2, I want to be long, and this is where I want to be long from, the third pillar says, well, given that, are other traders already long? Is the market already being pushed in the long direction? And that's, we're going to use the third pillar of price action and order flow. Sorry. And then the fourth pillar is what we call money management. And the reason we have numbers 1, 2, and 3, then the fourth is kind of set to the other side, is that numbers 1, 2, and 3 are determined by the market. They're independent of the individual trader, right? Market profile, patterns and inflection points, price action, these are all things that are determined by the market. They are external to you, the trader. But the fourth core now goes back to what I was talking about earlier, bridging the trader with the trading system. So now we talk about money management, psychology, trade management, what I call trading within yourself, not swinging for the fences, etc. So that's why I keep the fourth one separate, because what it tells us as we're educating traders is ultimately, when it comes down to you placing the trade, you're going to do things differently than the trader sitting beside you. Now, even though we run a chat room and we get 200 plus people in our chat room every day, it's clear that we don't have 200 identical P&Ls. Even though we're using the same tools and following the same markets, following the same moderators and trade alerts, the reality is at the end of the day that it's unlikely that you're going to have two people who have identical P&Ls on the day. And the reason for that is the reality of trading is ultimately every trader is different, and every trader is going to be guided by their emotions, their psychology, and their ultimate management of the trade. So it's very important that whether you're looking at our system or anybody else's system, that you don't reduce it down to the nuts and bolts of just numbers 1, 2, and 3. And over the years, it's probably one of the biggest mistakes I've seen traders make, especially new traders, which is, show me the entry pattern, Greg, and I'm going to make a fortune. And then you realize, well, you didn't manage it anything consistent with what was suggested. No, I managed it my own way. Well, the management is part of the system. You can't extract or pull the two apart. One works in tandem with the other. So one of the things that we do, in addition to teaching traders, and I'm going to actually walk you through the first core market profile. I'm just giving you the broad strokes right now. One of the things we do is we take this, what I call this envelope or this overlay of a positive trader psychology, and we wrap everything we do into what we teach. What does that mean? It means that everything is structured in order to be in a situation that improves your psychology, that you continue to build these neural pathways towards being successful and repeating that success over and over again. One of the simple tricks that we do is, especially for our newer traders, we have them trade for a daily goal, reach the daily goal, and stop trading, however small that goal is. The rationale behind it is once you've become accustomed to reaching a daily goal, protecting those earnings, it becomes easier and easier to do, and then you simply increase that daily goal as you move forward. So those would be, as an example of one of the overlays of positive trader psychology that we build into how we educate traders. Okay, so that's the broad strokes. Now I'm going to talk about market profile. So of the 3+1 cores of the trading zone, the one that is most interesting and the most fun to teach, and I believe the most fun to learn, is market profile. And the reason for that is it's just so incredibly powerful. It's a trading tool, technique, indicator, whatever you want to call it, that was developed many years ago by one of the world's most famous floor traders, Peter Stettlemeier. He developed it. He then licensed it to the Board of Trade. A lot of other people came out and began teaching it. Some taught it well, some, overly complicated it. I have what we call a simplified approach to using market profile, which basically means the indicator and the mechanism is tremendous. It'll give you an enormous view of what's happening in the market. However, I don't believe that you necessarily need all of those elements in order to use it and trade profitably. So what I've done over my 24, 25 plus year career is I found some interesting ways to kind of carve out the pieces that I like to use, and I like to keep it simple. And I'm going to show you my charts, and I'm going to show you some trade setups, and I'm going to show you what I'm talking about, and you'll see that I believe in simplicity, I believe in clean charts, and I believe in the power of market profile. In order to do that, I'm just going to walk you through about a 5-minute technical discussion of what is market profile. And if you want to learn more about it, you take a trial at the Trading Zone. I see that the offer has been put up. You go to thetradingzone.com/trial and you use the coupon TPUB. You could take a 7-day trial in our chat room. And you'll also get a complimentary video on market profile that's included in the trial itself. So basically what market profile does is it organizes one single day's trading data into a distribution curve, right? So this is a vertical distribution curve. On the right you have the prices that traded throughout the day, and these little letter blocks simply tells us that every time a specific price traded, one of these letter blocks was entered onto the distribution curve, right? And they move from left to right as time moves forward. What happens is, during the course of the day, all these letter blocks are being dropped on the distribution curve until one of them stands out furthest to the right than all the others, which tells us that that particular price level was traded more frequently than all the other price levels. Or put another way, it means that it's where buyers and sellers met most often and exchanged product. In this case, an S&P contract or a Euro contract, whatever it is. But this is where they've met most often. Put it another way, it means it is the center of gravity or the equilibrium point of the market. It is the most accepted price level. So obviously, if everybody met there the most frequently, and the most number of trades happened at that level, it is, by definition, the most accepted price level, right? So it's the center of gravity, and in market profile terms, it's what is called the POC, or point of control. From there, the indicator, which does all the heavy lifting, you don't have to worry about it. The indicator does it for you. Does the software use it? Yes, you can use the market profile software in any market. It's an overlay for this one I'm showing here is for a NinjaTrader, and it can be used in any market. From there, it then determines one standard deviation from the center of gravity and gives us the upper value area and the lower value area. So without getting overly technical or mathematical, what does one standard deviation mean? It means that all the data, all the price points that were traded inside these boundaries, upper value to lower value area, makes up 68.3% of all the data. And if you were to flip this thing horizontally, it'll look like what they call a bell curve. And you may remember from your high school or grade school days being, when you wrote an exam, you would be measured against fellow students in the class on a bell curve. In other words, the mark that you got or the grades that you got would be adjusted based on how everybody else did, right? So that was one of the earlier concepts of using a bell curve. It actually goes back to a mathematician by the name of Carl Friedrich Gauss in the late 1890s. who developed it. It's called a Gaussian distribution curve. But it was the genius of Peter Settlemyer who applied it to the markets. So now we have an upper value area and a lower value area. And what it tells us is that the relevant prices, the ones that were most accepted by the traders, happened within these two boundaries. And the irrelevant prices, so irrelevant in trading terms means traded less frequently with less volume, happened outside of these boundaries. Now for the longest time, people had to trade market profile, and some still do, using this type of configuration. As I mentioned before, I don't like complicated, and I don't like cumbersome charts. I like clean and simple. So this to me, although I can understand it and pull the information out of it, is still a little bit too complicated. I prefer overlaying market profile on a chart that is more visually appealing, something that I'm used to trading. So here's an example of the same brackets, and you can see how one represents one day, another day, another day, another day. And you can see how this is clearly a market that is what we call gaining value. The brackets are stacked one on top of the other, right? It doesn't mean that every price point was higher than the other. We can see sometimes the price is pulled down, but we can see that the area of accepted value, as defined by market profile, was higher than the prior day. So this is what a multi-day market profile chart would look at. Still, in my opinion, a little too complicated. So what I've done, well, and a lot of people do it now, but in the early days of trading, I believe I was the first to develop the indicator, was to take this information and overlay it onto my candle chart. Now all of a sudden, this is a chart that speaks to me. This is something that resonates with the trader. Why? Because we're accustomed to using candles or bars to evaluate price movement, and we're accustomed to using horizontal lines to identify supply, demand, support, resistance, whatever you want to call them, or what I like to refer to as inflection points on our chart. So by the magic of modern technology, and a little bit of heavy lifting and some elbow grease, we take the indicator, hit a couple of switches, flick a few buttons, and by pure magic, our levels are now represented right onto the chart in the time frame that we choose to trade. So market profile, by definition, is always measuring those different points on a 30-minute increment. So if a price traded within that 30 increment, it gets a little spot on the curve, and then it goes to the next 30-minute increment. But I don't necessarily want to trade on a 30-minute time frame. In fact, I like to trade on a 1, 2, or 3-minute time frame. So using the indicator, I can now represent these lines and levels right onto a chart that I'm more accustomed to seeing. Right? A lot of trading, by the way, in my opinion, is having something that is easily recognized, visually appealing. If you have a visually appealing chart with patterns that are easily recognized, then the probability that you'll hesitate to take the trade is diminished. A lot of new traders on their way to becoming successful make the errors not because they don't understand the market and not because they don't understand order flow or price patterns or technical analysis, but because the time it takes to look at it, evaluate it, and act on it had them hesitate, double think it, overanalyze, and then they got in late, they made a mistake. So by cleaning up the charts and showing just what we need, right? Like I said, a simplified approach to market profile, stripping away a lot of the redundancies and extra indicators allow us to focus on some of the patterns and setups that happen over and over again so that we can act on them really quickly. And already you can see a couple of things that are going on here. So what am I looking at? This green shaded area is the same as this distribution curve up over here, right? So we can see that the point of control is being developed right over here. The pink line extends to the right. We can also see yesterday's value area. So this fixed horizontal line, upper value, this fixed horizontal line POC, and this fixed horizontal line, lower value, actually represents yesterday's trading day. Some people say, well, why, Greg, would you use yesterday's information if you're trading today? And the reason is the following. As traders, we want to know if we're buying or selling something expensive or cheap. If I said to you, I'd like to sell you my watch, and give me $1,000 and it's yours. You don't have a critical piece of information. What you don't have is, well, what's the value of the watch? Right? If I said to you, my watch was a Timex, you'd say, well, for $1,000, you could keep it. But if I told you that my watch was a Rolex, it's probably worth $20,000, you'd say, I'm a buyer. In other words, let's take that information and let's bring it back to the trading markets. What I've done is I've analyzed two critical pieces of information. I've analyzed the price, which is reflected in the last candle on the hard right edge of the chart, and what I've compared it to is the value. So value is actually determined by what happened yesterday. Are we trading above value? Are we trading below value? Or are we trading inside of value? So the concept of value is, well, yesterday this watch was worth between $1,000 and $1,200, and today Greg's only asking $800 for it. It's cheap. Or yesterday this watch was trading between $1,000 and $1,200, but today it's trading for $1,500. It's expensive. Same idea with the markets, and it can be the S&Ps, it can be crude oil, it can be cotton, it can be whatever you want. The question that we're asking ourselves as traders is, given the current price of this market, how does that compare with the value of this market? So value exists as a range, an area between the upper and lower, and price is a given. We cannot dispute price. Price just is. This is the price of it. It's a buyer and a seller just met, and they exchanged a contract at this price. There is no disputing it. The question now is, and the search that we do as traders is, well, did he get good value or bad value for that? And the only way we can make that comparison is by comparing price to value. So the beauty of the indicator is it lays it all out there for you. These lines, when you see a fixed horizontal line, not the jagged one, the fixed horizontal one comes from yesterday's trading session, which means the levels are waiting for you today. When you open up your chart, these levels are sitting there waiting for you because they were generated from yesterday's session. Underneath below, you can see these jagged ones. Those are today's levels that are being developed as we accumulate the data. As that data is placed inside the distribution curve, it's calculating the levels that we'll then use tomorrow. So how can we take advantage of this information? How can we use this knowledge to our benefit? How can we structure a trading system around this? There's a number of different ways. We can use the levels to actually find trades. Right? It's not the only location that we can find trades on the chart, but I'm going to show you through a number of different charts that, by and large, the vast majority of the time, the best trades of the day are going to be off of these levels. We can also simply use, let's say you're using something else to find a particular trade entry, right? And there's a number of different ways you can find trade entry. But your question is, well, is this market continuing to sell off? Is it reversing on itself? Is it trending? Is it range bound? How do I know? Right. There's a lot of different ways that people have asked that question and attempted to answer it. Market profile is the only one that quantifies it. It says definitively, this is a market that's range bound. This is a market that's trending. So it gives you that information right away, which is nice. Anything that can be quantified, in my books, is preferential. And again, you can use, so that's what we call a guide to market structure and market direction. Right, market structure, market direction. So a market that is structured and direction does the following, as I explained to you. So here's an example of a market that is building value. Now, you can find a lot of the same information by drawing a trend line. But as we know, sometimes, well, where do you put the trend line? You got to, sometimes you have a large spike down, and it kind of messes up where you put the trend line, and your trend line ends up going all the way down over here. And sometimes you can't find just the right number of points to draw your trend line on. And the trend line sometimes doesn't look exactly the same on a 30-minute as it does on a 60-minute. And it opens up a lot of subjectivity. Market profile does not offer that subjectivity. It makes it objective and quantifiable. It says that a market where the brackets, meaning the value bracket, value area high to value area low, is being built above the prior one, where the POC, the point of control, that spot that juts out the furthest, is higher than the prior one, is a market that is building value. So if a market is building value, is that a market that you want to sell? No, that's a market that you want to buy. If a market is losing value, is it a market that you want to sell or buy, right? So it provides you the structure of the market, and it tells you which direction the traders are exerting their buying power or their selling power. So I go back to an analogy that I used earlier. Let's say you have this watch, and it was trading, it was selling, you're at, let's use, actually, here's a different analogy. Use real estate. Real estate's always a good example. You use your neighborhood, and you say, okay, the houses in my neighborhood have been trading, have been selling for, how much? If I said to you, what's the value of your home? It's very unlikely you'd turn back to me and say, Greg, the value of my home is $372,412. That would be a price. If I inquired about the value, you would say the value is between $350 and $375, right? So just intuitively, that's how markets work. We think of value in terms of a range. Now think of all of a sudden, whatever external factor happens, some big hotshot movie star moves into your neighborhood and buys a house for $500,000. All of a sudden we have a single price point much higher than the other ones. But it's changed people's perception about value. And now all of a sudden the houses no longer are trading for $350,000 to $375,000. They're trading for $500,000 to $550,000. And more Hollywood stars are showing up saying, hey, this is a nice neighborhood. Maybe I'll buy here also. If you were able to short that market, would you want to? Clearly not. You're using the concept of value to understand that the value brackets are being placed one on top of the other. And the only way that can happen is by the collection of individual price points, right? The value is taken from actual price points, the same way the tax man determines how much property tax you're going to pay by looking at the sales of real estate in your neighborhood, right? They take the individual price points and they say, well, the value must be X. So this is a market that's building value. By contrast, this is a market that's losing value, and it cannot be denied that the brackets are being set up one below the other. And it doesn't matter what market it is. They all look the same when you set up the indicator, but clearly you have a market that has value bracket, lower value bracket, lower value bracket, lower value bracket. I'm also not suggesting that there wasn't potentially a good long trade over here. What I'm suggesting is if you want to stay with the direction of the greater influence of the market, this is easily recognized, this spot over here, as a reaction trade, right? Something that is counter to the greater pressure of the market, which is clearly structured to the downside. This is a market that is what we call neutral. We can clearly see how the value brackets are overlapped one and the other. They are within each other. So it's a market that you can look at trading both sides, selling off the upper range and buying off the lower range. So that's what we call market structure and market direction. And it's only giving you a big picture. So that you can use market profile and you can combine it with some of the other stuff that you're using if you already have a system that provides you great trading levels, or maybe you like to use fibs or waves. Wouldn't it be nice to know that you're trading with the greater influence of the market using market profile as it defines structure. But let's say you don't have a system that also provides you the actual entry locations. How would we go about using market profile to also provide us that information? Well, we can. I'm going to show you a bunch of charts, and everybody's going to say, "No, you drew those yourself." And then what I'm going to do at the end, as I scroll through these charts, I'm going to show you today's market. All right, I'm just going to pull up a few of today's charts that are actually live and trading right now, and we can evaluate them together. So as I mentioned, the fixed horizontal lines are there when you wake up in the morning and you turn on your chart. Right? They're waiting for you. They were developed and calculated from yesterday's trading session. So there's a number of decent opportunities in this day, but clearly one stands out as a better opportunity than the others. This is clearly a market that is what we call neutral. It is contained within the upper and lower boundaries. And once again, there's clearly one, I'm not suggesting it's the only opportunity, right? We like to reduce and simplify what we do, so we're looking at just the concept of using these levels as trade entry locations. Clearly there's one area that provided a better opportunity than all the others. I'll give you a hint. It's usually the one that's circled in yellow. Here's an example of a market that had a number of opportunities, and this is a little bit more consistent with an active market. You tend to get 3 to 5 opportunities in a day. Right now in the summer months, 1 to 2, just because the markets have been quiet and the volatility has contracted. But we have a nice support off the upper value area. We have a retest of that support. We have a failure that we came back in, and notice there is no trade over here, right? Because before we shorted this, we needed to know that there was a willingness on the part of the traders to actually get short. So one of the things about technical analysis, and this is a different presentation that I do, is understanding that technical analysis is about measuring and not predicting. So we didn't know that this was going to happen until this happened. So sometimes you miss the first move because it has to happen so you can measure it and you pull out your tools, be they market profile or RSIs or stochastics or fibs. Right? You can't draw a fib on something that hasn't happened. And a lot of traders mistakenly try to predict as opposed to measure and then evaluate. And you can see how it provided another couple of great opportunities. And again, I'm not suggesting that there were no opportunities inside the bracket. The better opportunities, but ones that almost always provide the largest move of the day, happen off of market profile levels. These are all 2 and 3 minute charts that I'm showing you. And it doesn't have to be. Again, in the background, when you set up market profile, it's actually being calculated on a 30-minute time frame, but I'm representing these levels on a 1, 2, or 3 minute chart. In other words, what I'm saying is this horizontal level is not going to change throughout the day, but when I want to get down to the very granular entry location, and I want to use candle pairs or candle combinations or spikes or pullbacks, I want to do that on a 1, 2, or 3 minute chart. I want to really get down to a very, very fast time frame, what I call the granular level, because I don't want to use a wide stop. So, but you can equally overlay the market profile on a range chart, a tick chart, on a volume chart. It doesn't really make a difference because in the background, it's always being calculated on the same basis, and then you represent it. You just set it up to show it, to display it on the chart and the time frame that you choose. And again, so there was a nice double bottom over here that was tradable, and I'm not saying it's outside of the scope of what we do to trade something like that. What I'm saying is strictly on the approach of using the levels of potential trade entry locations. You will see in every market, day after day after day, that there are some of the best trades that happen right off of these levels. Here's an example of using what we call a prior level. And sometimes you have to do that. Sometimes the market didn't give you the opportunity to use yesterday's level, and you have to go searching a little bit further on the left to find another level to use. And that's okay. We explain and teach how to do that. There's a reason and a rationale behind each of those trade setups and patterns. Now, there is a particular trade that's happened over and over again in these slides that I'm showing you that is called the 80% rule. And this is a term and a name that was given not by me, but rather the developers of Market Profile. And the reason it's called the 80% rule is that it works 80% of the time, which is an incredibly high percentage trade. It basically says the following. When a market fails to stay outside the bracket, right, and comes back in, 80% of the time it will travel from one extremity to the other. So if you go back and see some of the prior charts, go to find ones that are inside. A market that failed to stay outside, in other words, it came back in, has an 80% probability of going from one extremity to the other. And then it did the same thing over here. Failed to stay outside, 80% probability that it goes back to the upper level over and over again. So I didn't coin that trade, but it is one that is probably the favorite amongst our traders for obvious reasons. I'll go back to my earliest slide when I talked about trading psychology. And a lot of traders say, yeah, but look, you gave up all of this up here. Right? Let's say you just took this 80%er over here, the 80% rule, from 1121s up to 1131.50s. Look how much you left on the table. And that goes back to one of the earliest comments I made, which is when we teach you to trade for a goal, for a financial daily goal, what happened after you took your profit and you reached that financial goal is no longer relevant. The only thing that's relevant is, can you come back tomorrow and find that same trade? Now, I would much rather be in a situation where I can reach a daily goal by finding any little spot on the market than having to find the low and trade it up to the high. Because I got to tell you, I've been doing this for 24 years. I have met very, very few traders in my career who have been able to find the tops and find the bottoms. And those who attempt to tend to have short-lived careers. But I know a lot of traders who have made their livings and are still traders a decade later, 15 years, 20 years later, because they know how to find the sweet spot, the high probability, high percentage trade. So sure, there was another 15 points to the upside. But my business plan said all I needed was a tiny little piece of it on a higher probability. So it's like what I said earlier, you measure and then you trade it. Right? You don't predict it. And if that measurement says, well, this is all you need from here to make your daily goal, isn't it nice to find that repeatedly day after day in an environment of 80% probability? And again, a market that failed to stay outside breached the upper value and came to find the lower value. It's the same scenario. Sure, there's a lot more money on the table down over here, and maybe all of that was left on the table. But as the introduction that I was given said, we really try to focus on the opening 90 minutes, because this scenario where you have either a value level acceptance or a value level rejection tends to happen within the first 30 to 60 minutes, which means that you can structure your trading day to work 90 minutes, right? Because you got to give it 30 to 60 minutes to set up, and sometimes you're in the trade for 30 minutes. and still manage to capture 40, 50, 60% of the total range with high probability. It's a much better time of the day to trade. So almost always what we find is the market is going to provide a number of intermediary moves which are not bad. We certainly teach scalping techniques, and that's a decision that traders make. However, once you adopt market profile and either use it as your core indicator for market structure, market direction, or you use it exclusively for direction and trade location, what you realize is that on a regular basis, the market almost always puts in its big moves off of a value area high or a value area low. You may also notice that almost none of my trades, or at least none of the trades identified in these slides, were off of the point of control. It's one of the more basic errors that market profile traders make. If I told you that my watch was worth $1,000 because yesterday everybody was buying it and selling it for $1,000, but today you can have it for $1,000, why would you want to buy it? Why would you want to buy something for exactly what it's worth? It's one of the very, very basic mistakes that market profile traders make, and unfortunately I've seen dozens of educators teaching these things who don't really understand the concepts behind it. If it's the point of control and you're at equilibrium, you're looking to buy something and then resell it, or sell it then buy it back. But if the price is equivalent to the value of it, you have no edge. There's no edge on that trade. What we're trying to do is buy something cheap when the value is rising. Right? So we've got a great little pullback here in a market that's trading above value. So one of the great things about market profile is it works in any market. It is not specific to one market. You trade the E-minis, gold, currencies, the bonds, the agriculturals, whatever you want. Forex, doesn't make a difference. Those lines, those levels, those setups exist in every single market. It's different than most other indicators. As I explained to you, you see these distribution curves which look a little bit different than what you're accustomed to seeing. However, if you use the proper configuration of the indicator and you overlay it onto the charts like I've shown you, everything comes to light. Right? Now you can truly evaluate the relationship between price and value, which is what we're doing all day long as traders. This is the price, it's a given, I can read it off my chart. But based on value, am I buying it too expensive? Am I selling it too cheap? Right? Or am I buying it really cheap and it's going to go up? So it's that constant comparison, value versus price. It's easy to learn. Contrary to what most people think, it does not clutter your chart with useless information. I showed you some really, really clean, crisp charts. It works in any market, as I explained. It clearly identifies the optimal trading levels. We showed that over and over again. I'm going to show you a couple of today's charts. It provides the entries as well as the exits. I explained to you how the markets like to move from one level to another repeatedly, over and over again, which also allows you to stay in for the big moves. Because it's telling you the probable destination of the trade, it allows you to plan your trade accordingly if you want to stay in for that whole move. The best part about it, and which every trading system should offer, is that it is objective, accurate, and rules-based. Right? So sometimes you come across trading educators who say, well, this is a good area where I'd like to be buying it. And the area they give you is like 4 times the size of the stop you want to use. There's some inconsistency in that. We don't buy those. We buy specific prices. A market profile gives you objective, accurate price levels. It's not an area. We have the value area, but then it's further defined by the actual value area high, value area low. Those are defined price levels. Now, it may sound easy. I go back to the very first slide that I brought up, where I explained that trading is about A, the mechanics, and B, the psychology. And bridging those two things is what is difficult, what requires constant practice and attention. Traders don't fail because they have an inability to find a pattern or locate a horizontal or a vertical level on their chart or read an indicator. You know, that is, that's like building a puzzle. That's just pattern recognition, which can be taught to anybody. The mechanics of trading can be taught to anybody. Bridging it with you, the trader, who is encumbered by psychology, fear of loss, greed, etc., that's the constant struggle. Traders fail because of their inability to manage risk, not because they can't recognize a pattern. One of the things that we've encountered the most in our educational series over the past 11, 12 years now is that traders trade outside of their comfort zone, which then prevents them psychologically from following the rules. So it goes all the way back to defining that trading business plan where you take full responsibility, full accountability of your maximum exposure, meaning how much can you possibly lose. And once you become really comfortable and familiar with that number, then you've taken the first step to overcoming the downside of trading psychology. Now you can work towards the profits. That's not something that you want to do intra-trade. It's not something that you want to evaluate while you're looking to put on a trade. That's when you make mistakes and you get all worried about losing money and you make sometimes some critical errors. That's stuff that you address before you even come to the trading desk in the morning. If things go terribly wrong today, what's that going to look like? Can I live with that? If the answer is yes, you're inside your comfort zone. You know how many contracts you should be trading. You therefore know how many trades you should be taking and what your maximum exposure is. So trading outside of your comfort zone is probably the #1 biggest cause of failure that we've encountered. And it's the reason I bring it up within the context of showing you market profile is I don't believe in separating or segregating those two elements of trading. Because if you do, you're setting yourself up for failure. You have to combine both of them. You have to acknowledge the fact that there's the mechanics that is learnable and teachable, and then there is the personal side, which is the everyday ongoing work. Right? You got to get in there, you have to work at it, you perfect your trade, you tweak a little bit, you do a little bit better, you go back, you review, etc. I will do one other thing, as I mentioned. So this is the chart of this morning's NQ, right? So the current price is over here on the right. That price is a given. Now, this is today's chart, so I couldn't have messed it up. I couldn't have done anything with it. There are 3 lines that were on this chart when we woke up this morning, and those are the upper value area, the point of control, and the lower value area. And clearly you can see that there is one location that, without any possible discussion, offered the best trade opportunity of the day. Well, so far, maybe that'll change. So it's exactly like the charts I was showing you earlier. Let's pull up another one. This is the E-mini S&P. Today's chart, still live, trading at 1949s. 3 levels. Clearly, there is one price level that was waiting for you this morning that definitely was the best opportunity of the trading day. I don't have it highlighted in yellow because I didn't draw up these charts, but we can see how that looks. Lastly, this is a monster sell-off here in the CL crude oil. So this market was originally neutral, right? You would have waited for the failure for it to come out, and you can see the inability to move back in to launch a trade to the short side. Remembering, of course, that a market that is building value below its prior value is a market that is structured short that you're looking to sell. And you can clearly see how there is one spot that far outweighs all the others. And here's yesterday's actually. You can see upper value area, 80% rule to the downside, failure to remain outside, upper break of the lower value area, 80% rule to the upside. Over and over again, every market, day in, day out. It's a phenomenal, phenomenal tool. And that actually brings us to the Q&A period of this presentation. Let me just see if I still have my... Yeah, we can leave that up. Sure. Now, yeah, so an offer has been popping up every so often here. If you go to the tradingzone.com/trial and use the coupon that says TPUB, you can join us in our chat room and see exactly what we do. Thanks, Al. I know I saw from your earlier comments that you were probably one who was skeptical of the presentation. We get that all the time. One of the things I always do is I provide in-depth education whenever I do a presentation. And the reason for that is, number one, I don't want to waste your time. I certainly have been on the other side many, many, many times watching other people's presentations and experienced a lot of, you know, I guess, stress about the fact that I would spend an hour and a half, and nobody was actually prepared to tell me anything that I didn't already know, or actually teach me anything. So one of the things that I made a commitment to when I became an educator was I'm going to educate. Now, some of you may feel, this is all I need. You know, why would I want to go any further? That Greg just taught me everything I want. The reality is that in a 45, 50-minute presentation, the likelihood of becoming, you know, the world's best market profile trader is slim to none. I've opened your eyes, I've taught you a bunch of things, and hopefully I've whet your appetite, and you'll decide to come and take a trial and see a little bit more about what we do and take it to the next level and actually see the trades as they happen live, how we treat the markets. You know, trading is a live endeavor, right? It's something that happens, it's dynamic. The success rate, well, when we talk about success rate, it's a difficult thing to put your finger on. If you want to know the success rate of the methodology itself, since its inception in 1998, is about 78% winning trades over losing trades. If you want to know the success rate of an individual trader, you would have to speak to the individual traders. You know, people talk about success rate, but the reality is a system on its own doesn't trade, right? And we talked about that the very first slide. You, the trader, make it work or make it fail. So we do our back testing, and we look at the numbers. You know, the numbers are great. The system works. Do we have traders who outperform the system? Yes, because they're phenomenal traders. Do we have the same traders in the same chat room who can't seem to make it work? Absolutely, because they're not at that level yet. So, you know, you have a system in and of itself doesn't do anything. Nice, I like that comment. The trial will be available next week. Absolutely, you can take it. Actually, better to come in on a Monday, so you get the full week. There's a number of different indicators, right? So there's the one I'm showing you here. This particular chart is crude oil. That's the CL, which is crude oil, so it's a commodity, not a stock. The platform that you're looking at presently is NinjaTrader. The indicator is an add-on that we don't charge for it because we are an educational company. So if you decide to take our educational course, we will give you the indicator for free. Others may charge for it in addition to their education. We don't, because you can't possibly learn the methodology unless you have the indicator, so it would be inconsistent. We do offer some one-on-one mentoring. In addition, we do have a live daily chat room that we've been operating since 2003. So that's, how many years is that? 10, carry the 1, 12, 13, 12 and change. It's live. Yes, it's like a live seminar, but it's actual Well, I wouldn't call it a seminar because during the trading day, the educational component goes to a minimum, and the live trading, the actual taking of the trades, goes to a maximum. Is our platform available in Canada? Yes, it is. Absolutely. Do we have a track record on our website? No, we don't. We're actually, as educators, prevented from doing so, as are most educators, because it gives the mistaken impression that everybody is going to achieve the same results, which on an educational basis cannot possibly be, as I mentioned earlier. But also, the regulations state that our educational package is $3,700, and we do have a current discount. If you take the trial, you'll get the $500 discount, so it's $3,200. It's a one-time fee. It's a lifetime membership. It includes ongoing access to the trading room, ongoing access to the training sessions. We do training sessions twice a week, and it also includes the indicator itself. So, because we're yes, we have one for TradeStation as well. Sorry, I thought I answered that. Will the indicator work on Thinkorswim? Okay, so Thinkorswim actually has one built in, and it's a bit of a workaround to get it to do the right thing. A number of our members have managed to tweak it, and we do have an explanation file on how to do it. If you're not tech savvy, it may be a little bit cumbersome. If you're using Sierracharts, it's already built in. So we can get you set up with Sierracharts. So what we're interested in teaching you how to use it and build a trading plan around it using our methodology, right? So whether you want to, whether your indicator is on NinjaTrader or TradeStation or multi-charts, it doesn't make a difference. It's like saying, oh, is the MACD, the MACD is available everywhere. Not every platform, for whatever reason, includes market profiles, so sometimes it's a third-party add-on. But we make sure that you have everything when you join. We only have one product that we sell, and that is a lifetime membership. And the reason we do that is that the company was founded by traders for traders. I was a trader for 11 years before I became an educator. My co-moderator was a 20-year floor trader at the Chicago Board of Trade in the 30-year bonds. And, this is a great business. I'm not going to make I'm not going to deny that. I enjoy the education, but we run our business a little bit differently than other companies, which means one product, one price, lifetime membership. There's nothing to upsell you. There's no additional indicators you're going to need. I'm not selling you 20% of the methodology, then telling you, oh, you need the other 30%, and look, I just invented something. It's the same methodology that has been in place for well over a decade. Why change if it ain't broke? And because myself and the other people who run the company have been on the other side, we know what it's like to constantly being upsold, and it's not pleasant. So if you go to our website, you'll see we have one product, lifetime membership. There you go. Everything is in. Any intentions of doing a one-on-one in person? We may be at the Vegas show in November, to be determined. We've done that in the past, but I can't give you a for sure just yet. It's a possibility, a probability. A lot of stuff we do is online, obviously. Our educational materials are constantly being updated. It doesn't mean that we're changing the system. What it means is every time we do a training event, we upload that to our archive, our library. So our library is growing every day. So we just uploaded 2 more sessions this week. We uploaded a great one from last week, how to trade the first 90 minutes. It's, our community is always growing, our materials are always growing, etc. I see somebody is trying to get on the mic. So does that mean my time slot is over? You're welcome, Bobby. The trading zone. No, you can't get to the website? Have you guys all crashed my website? let's see if I can pull up a there it is. We do have a website. We do. Really? Oh boy. You guys. I'm under attack on the trial page. I see. Well, give it a couple of minutes. Maybe. Well, it's coming up for me. Yeah, I guess everybody try to hit it at the same time. So, copy down the link and it'll if it shuts down for sometimes it's just too much traffic and within a couple of minutes or whatever it is. And you can hit the About Us section and you can. Oops, I see what's going on. Yeah. All right. Okay. Everybody, back off. Everybody, go easy. You've taken down my website. Copy down the link. What a time to have a database error, huh? All right. It'll be back up in a couple of minutes. And you can grab the link from the highlighted orange box above the text. Thank you. Let's see if I give you straight to the other site. Yeah, I could do that. TradingZone.com is our marketing site. The TradingZone.net is where you sign up for services. So you can also use the TradingZone.net sign up -trial. The market is a lot more traffic, so that's probably why. There you go. Put it out there again. Perfect. Great. So I hope that the time was well spent. I hope that it was educational and informative. I hope you got a little feel for how I present the materials. This is what I've been doing for a long time, so it's second nature to me. Anytime you want to have a conversation about your trading or learn more about market profile, I am passionate for what I do. It's been an amazing journey since I've been in my early 20s. I'm now 48 years old. And it's just been a tremendous, tremendous journey being able to earn my living from the markets as a trader and as an educator and meet fellow traders over the years. So, drop us an email. Tell me you want to talk about your trading, or you're interested in some education, or you just want to stop by and see what we do in the chat room. And we'll do whatever we can. We don't claim to be for everybody. It's impossible to solve everybody's trading needs, but certainly we are for some of you. Is it tax deductible? I guess it depends where you are. It should be. It depends on how you run your trading business. Most of the time it is. Depends, again, what part of the world you're in and how you treat your business expenses. Where I am, it would be a tax deduction. Okay, so I'm going to hand the microphone back over unless there are any other questions.